Good afternoon. It's my pleasure to welcome Karolina Bassa from the University of Oxford today at WIFO's Research Seminar. I hope technically we're all set up well and that everybody can hear us, that we're all in a good shape. So it's our pleasure to welcome Karolina. I met Karolina this late spring, early summer, actually, in England at the Institute for New Economic Thinking at the University of Oxford. But she actually has a double affiliation, if I get it right. She's also affiliated with the Mathematical Institute. Her research interest is in public spending, fiscal policies, and sovereign debt, and debt sustainability as well. So it's only natural that she's also interested in credit shocks, big events, as well as the wider events, if you want, things like climate change as well. Before her academic career at Oxford, she is also busy working in the financial industry in the City of London, actually. Yeah? So she actually has practical work experience for organizations like JP Morgan, but also James Street Business Development. This is a very interesting perspective because she combines in her work various strands of the literature from both mathematics, systems theory, but also economics. So this, in addition to her practical experience, gives her a very unique way of looking at things that is very relevant. Certainly for topics like the very topic she's going to talk about today, which is a quantitative model of sovereign credit risk and debt sustainability. So Karolina, the floor is yours. As we discussed, the presentation should be about half an hour. Then we're going to have a comment provided by Thomas Url, and then we're going to head on to the general discussion. So Karolina, again, the floor is yours.
Thank you so much. Thank you so much for having me. Well, that was a long introduction, so you know now everything. The model is a combination of financial thinking and economic thinking. So it might be a bit different from the standard macro models. So at the beginning, I should also mention that part of my PhD is funded through a research grant from the European Union. So first I will talk quickly about the motivation for the model, then introduce chunks of the model itself. Then I will move to the empirical results. Depending on the time, I will show either two or one country. And then I will present how we can do policy analysis and sovereign debt sustainability analysis with the model. And in the last chunk, I will show how we can use the model to derive granular credit ratings with a transparent methodology. And time permitting, I will move to some analytical results and summary. So in finance, there is a huge literature on quantitative modeling of corporate credit risk, so risk for firms. And we distinguish between the models focusing on solvency and liquidity. So insolvency is when the value of assets falls below the value of liabilities, and the illiquidity is when an entity doesn't have enough cash to pay its short-term debt obligations. And starting with Martin, people use structural models based on option pricing to compare the value of the assets and liabilities in corporate credit risk. And that's strictly a solvency model. And we argue in the paper that it's not easily transposable to sovereign debt because the solvency of a sovereign is a much trickier thing to define. And also, upon bankruptcy, it's not like the creditors come in and claim the land or the people or the companies of the country. It's true that countries sell some of it, like Greece sold its ports, but it's a very small portion of what Greece actually owns. So we argue in the paper that when thinking about credit risk for sovereigns, we should be focusing on liquidity instead of solvency. And there is macro literature that models the spreads and the defaults of sovereigns. So that's from the tradition of Eaton and Gersowitz and then Arellano. And there is a separate literature that models debt and fiscal sustainability, but there is very little work which combines both modeling the spreads, that sustainability and default, even though all of those concepts are very tightly interlinked. So what we do in our work is we introduce a quantitative model of sovereign debt dynamics and credit risk based on the dynamics of the government budget. So the focus is on liquidity, and the central part of the model is the inflows and outflows of the government budget. The model is small enough to offer analytical tractability, and we can analytically derive the relationships between the key variables. It offers good agreement in sample, realistic dynamics for variables, conditional on output. So we assume a GDP pathway, and based on that, we derive everything else for long horizons, up to 10 years. And the model generates realistic sovereign credit ratings with a transparent methodology. So that's better than S&P and Moody in the sense that we know what's happening and what goes into the ratings. And we will show how we can use it for DSA, so the sustainability analysis. So the model itself, it consists of three entities interacting. So it's the government, domestic private sector, and international financial markets. The default occurs if the demand for borrowing from the government exceeds the credit supply that financial markets are willing to offer. So it's a liquidity-induced event. And the government decision is a proceeding horizon optimization problem. So it's not a general equilibrium model, but it has an equilibrium, and the investors are boundedly rational. So this is the model timeline. So it's a multi-period model, and within each period, we have a sequence of actions, which starts with the stochastic shock to GDP. Then we have domestic private investment, public spending, revenues, and based on that, we calculate the budget balance. And the budget balance, the deficit and the rolling over of previous debt is what the government wants to borrow. And based on that, it decides its fiscal policy for the future, so the tax rates and investment. And then it goes to the financial markets, and if the credit supply is sufficient, it borrows. If it's not, the default occurs and the simulation stops. And if the credit supply is sufficient, there is credit pricing and credit rating for the future periods. So that's the core of the model itself, which is the outflows and inflows of the government budget. So on the outflows, we model the interest expenditure, government investment, government spending, and the principal repayment. It's a multi-period debt. And on the inflows, we have the new debt, tax revenues, and savings from the previous periods. And as I said before, the demand for new borrowing is the positive part of the principal repayment and the deficit. And for most countries we are of interest, this is a positive quantity because most countries actually roll over their principal repayments. And we model everything in real terms in base currency. The base currency for each country is the main currency in which the debt is denominated, which for countries in euro area is easy. In countries which borrow from financial foreign markets like Argentina, which we also model, this is a bit problematic. But Argentina, for the period in which we model, their currency was actually pegged to the US dollar, so it's not an issue. We don't model FX endogenously in the model. If FX is needed, we take it as a exogenous time series or use some other model to model FX. So output of the economy, out of the components of the output, we only model directly investment. The remaining components, so the private consumption and the government consumption and the export balance, that's we just model it as a log linear process, as in AR1 with stochastic shocks. So the final output is basically this chunk of investment and the AR1 used to in logs used to model the remaining components. We only model investment directly because it's the most volatile of the GDP components and because we want to have investment decision of the government in there. And then we model investment as a sum of private sector investment and government investment. So the government invests a fraction, beta, of its tax revenues, and beta will be one of the policy variables that the government decides. And then private sector invests a fraction of its after-tax revenue, after-tax income, which grows with the output growth. So that's a bit akin to the accelerator models in macro, but it's not exactly an accelerator model because accelerator models do not generate, cannot replicate the data in periods of long stagnation or recession, which is usually when the debt crises happen. And the fiscal policy that the government decides is the tax rates and the fraction of revenues the government wants to invest. It chooses it every period out of two possible values. So there are the business as usual values based on the mean value in sample of the data. And then there is the fiscal austerity values, which we calculate by using this parameter phi, and that parameter basically tells us how strict the austerity is. So the fiscal austerity taxes are the higher taxes, and the fiscal austerity beta is lower beta, which means less investment of the government. And the government chooses the policy by minimizing the deviation from fiscal targets, the growth, deficit, and debt to GDP. Normally, in macro models, you would have here optimization of the maximization of the consumption over for the households over infinite horizon, and then you would use Bellman equations to calculate the equilibrium. We chose the fiscal targets because more than 100 countries globally actually have fiscal targets, and they periodically publish them. And it's more akin to what the governments actually do. And we have finite horizon optimization because, well, we don't really think that governments look so far ahead. They're more concerned about the next elections. And the government optimizes over finite horizon, implements only the first step of the policy, and the next period it resolves the problem and also implements only the one step. So it basically updates its policy every period. And we, apart from the targets, we have a penalty here for the default. So if within the horizon of optimization, if there is a default, then the government definitely puts the fiscal austerity policies in. And there is also a penalty for raising taxes. So the government would prefer to cut investment before raising taxes. And there is empirical evidence that this is what governments do because it's politically less costly to cut investment. Okay, and then here's a lot of equations. All what I'm saying is that the principal repayment, debt dynamics, interest expenditure, and average cost of debt, that's all accounting equations. So there is nothing actually interesting here. They just simplified accounting identities. And the more interesting bit perhaps is the financial markets unit. So we have, as I said, a cap on credit supply. The government cannot borrow infinite amounts of money. The cap is further lowered if the sovereign is classified as high yield sovereign, because many entities in the financial markets actually, due to regulation, cannot issue credit, cannot buy the bonds that are rated high yield, like pension funds, for example. And within the model itself, we have only two credit ratings, the high yield and investment grade. But I will show later in the presentation how we can use the model to derive the granular credit ratings. And the credit ratings, threshold. So it's a very simple mechanism, and the threshold is estimated from data. The Vmax, the maximal credit supply, is the maximal gross financing need in sample that we observed. And the default occurs when the debt demand exceeds the credit supply. The sovereign credit spread pricing is based on a standard relationship. So the spread is equal to the probability of default times 1 minus the recovery rate. So the tricky bit is trying to calculate or estimate the probability of default. So this is a market estimate of the default probability, and it's basically an estimate of the liquidity shortfall the following period, so that the next period the government will demand more than the credit markets are willing to supply. And the investors use the equations of the model to do that with some two assumptions that basically they assume the credit rating will be the same next period as it is now, and that there will be no additional shocks to spending. And we can rewrite this probability as a function of the current state of the model, the borrowing cost, and the stochastic shock to output next period. And when the financial markets estimate this probability, they use the same model for output as we had before, with one little change, which is this sigma here. So it's a different sigma from the output. In the output, we use sigma y, and here we have sigma. And the idea is that we don't model here risk premium. But what happens is that when we estimate this parameter sigma using the best fit in sample, we expect the sigma to be actually higher than the sigma in the output, because in our model, this shock is the only source of uncertainty, while in reality, there is much more uncertainty, right? There's uncertainty about the recovery rate, about the other budget variables, and so on. So we expect that the market's perception of the volatility of the output will be higher than the actual process we use for the output. And the joint dynamics of the state variables is a receding horizon equilibrium with bounded irrational investors, because they are bounded because they make those simplifying assumptions, and they only forecast next period, right? If the government control solves the H-step problem at the state X, which I presented before, and the interest rate is a fixed point of the pricing operator. So basically, it's the same equation as on the top. It's just now written as a fixed point. And the states and outcomes evolve according to model dynamics. So in the paper, we show that the equilibrium exists, and it's unique under certain conditions, which occur in most cases of interest. Okay, that was quite long. That was the model itself. And then there are quite a few parameters. What is important about them is that a great number of them are observables. Then the other ones we take from the reduced form models that we estimate on data in sample. And then there are policy parameters that we try to take from the official documents that the country publish. And then there are some data proxies that are based on, well, for the credit ratings, the model is very simple, and we use a threshold value that is taken from data, but it's not perfect. And the only free parameter is the standard deviation of output shocks used by the financial markets to estimate the probability, and we calibrate that we estimate that using the best fit of spreads in sample. So now moving to the empirical results, we calibrate the model to Greece using data from 2001 to 2007 on a quarterly basis, and we assume heavy tail distribution of shocks, because empirical evidence shows that shocks to GDP are actually heavy tailed, and we do those experiments ourselves as well. And we do a conditional test. So we take the historical pathway of the output for Greece, and we use it as YT minus 1 in this output equation. And we simulate from 2008 Q1 onwards, and we use policy targets from the Stability and Growth Program that they published in 2007, I think. The model predicts a default in the first quarter of 2012, 16 periods after initialization, so 4 years after. It predicts the downgrade of Greece to high yield in the third quarter of 2010, 1 quarter after the actual downgrade, and the forecasts the dynamic of the variables quite well, which you can see here. So it's a big graph, so I will explain what all of that means. So in the first panel, we have the stock of debt. Then we have interest payments, balance, private investment, credit rating, and bond spread. The model is in blue, and the data is in green, and the x-axis is the time. So we see that we actually, the dynamic of debt and the interest payment and private investment is really good. The bond spread kind of goes very high, very close to the default, but the dynamics roughly agree. As I said, we have the credit rating downgrade 1 period after that it actually happened, and we have a fiscal action earlier than Greece itself, which corrects the balance there, but it's not sufficient to actually stabilize the balance long term, and it starts deteriorating from 2010 onwards. And just to have a comparison, we do the same for Argentina, using the data from 83 to 93 for most of the parameters, and for the sigma we use from 90 to 93 because there was a default in 89, and the spreads, it's hard to calibrate the spreads, including that default in 89. Again, heavy times shock distribution. We initialized the model in 1994, and we use 1 year for optimization horizon for Argentina, and we use 2 years for Greece. In the appendix in the model, in the paper, I show the results for 2 years. Again, we have realistic spreads. So this is the same graph, but for Argentina. The jump here in the stock of debt is because of the release of the FX peg. So the Argentina released their currency, and quickly, within 1 quarter, it went from 1-to-1 to 1-to-4. And this is without the FX shock. So in the model, we have the raise of spreads without the FX shock, just purely to the budget and the overall economic conditions. And we also have a default, but 2 years later, without the FX shock. If we introduce the FX shock, then we have a default at the time of the FX shock, which is 1 period after Argentina defaulted. So that's the conditional spread prediction using the output pathway. But as I said, we want to show that the model can be used for policy analysis and the sustainability analysis. And also, we don't actually know the future pathway of output, right? So we want to know whether the model is useful if we have no knowledge about the future. And in the IMF definitions, IMF says that public debt is sustainable if the debt stabilizes with lower financing risk under a feasible set of fiscal policies. And the objective of DSA is to establish whether that is sustainable with high probability, which means that the DSA models need to have a probabilistic component and the fiscal policies included inside. And we run this hypothetical exercise that starts in the first quarter of 2009. And what we do is we calibrate the model using the data up till that quarter. And then from that quarter onwards, we simulate 4 years, 4,000 times. And in each period, we shock the GDP with a random shock drawn from this heavy tail distribution. And that gives us an ensemble of debt pathways. And then we basically look at this ensemble and how many of those pathways ended up in default and what was the mean trajectory or median trajectory of that. So in here, we have the simulation and the The defaulting pathways are marked in red and the non-defaulting in green, and the mean is the blue line. And in the 2009, we got that that 11% of the pathways out of this 4,000 defaulted, and in 100% of those scenarios, fiscal policies actions were activated, so the policy switched to fiscal austerity, and the debt to GDP grows, and the 95th quintile is 156% of the GDP, while the targets were closer to like 90%. Okay, but here we had a fixed value for the fiscal adjustment, right? And the country in a debt crisis, well, the key questions for it is the size and the type of fiscal adjustment necessary to stabilize debt, the effectiveness of bringing the debt down, and the damage to GDP growth that it will inflict. So in the previous exercise, we just had a mean trajectory of that under assumed fixed fiscal policy, fiscal austerity extent. But in here, we will experiment with the tax adjustment and the investment adjustment. So we'll split the adjustment into two, no longer with one parameter, but two, and we will model it on a grid. So each point in the grid is the combination of those two adjustments. And in here, we don't put the stochastic shocks. So this is the model equations as if they would develop without stochastic shocks, but also no assumptions about the future. And we could do that stochastically as well, right? It's just like each point will be 4,000 simulations. And we basically track the cumulative output growth and final debt to GDP ratio for each of those simulations on this grid of policy adjustments. And in white, you have the defaulting cases. So even if we didn't assume Greek debt output trajectory, the model itself in 2009, without fiscal adjustments, tells us that within 4 quarters it would default. So it needed fiscal adjustment, and then we can see which kind of levers are more effective. So we see that they're equally effective in avoiding default, but the cost to output of cutting public investment is higher. So that's the red region on the first graph. And also we see the size. So to actually to limit the debt growth, the adjustments needs to be of like 15% of tax increase, right? Which I leave it to the country experts whether that's feasible, probably not, right? But it gives us the trade-offs between those two policy levers. So that's a very short run for the policy exercises. But the, I guess, interesting thing about what we did with the DSA here is that we can use the model to give us cumulative default probabilities over extended horizon of time, right? And we can use these cumulative default probabilities and compare them with the frequencies of defaults per credit rating class. And this is actually how we derive the granular credit ratings. So at each quarter, we estimate the model up to that quarter. Then we simulate forward for 4,000 times using the stochastic shocks to GDP period. And then we look at how many of those pathways ended up in default. And then we compare that with the frequencies per credit rating class, which gives us the granular credit ratings for each country. So this is Greece. So we did this exercise for each time period, for each quarter. And at the top, we are close to the actual rating in the stable times early on, but not on the rating. But in here, the differences between rating classes is really small, right? Like the frequency over 4 years of countries defaulting, which started with AAA, is like, I think it's 0, and with A, it's 0.06. But our rating decreases much earlier than S&P's. That partly has to do with the fact that we have the data after corrections. I have the data before as Greece was publishing it. I still need to run it on that data to see what would our model say as the reporting came in. But we see that the model signals the risk earlier. And this is for Argentina. So we, at the beginning, overestimate, partly because we don't look into the history of the country, the previous defaults, and so on. We just take current conditions. And then we underestimate. We also have this, in 1996, there were reforms, there was an increase in the rating of S&P and also ours. But again, we downgrade to CC in the first quarter of 1999, while S&P still kept Argentina at BB, which might be an earlier indicator of risk. And again, our model is more reactive, but also has higher variance, right? Because it just looks at the current economic conditions and the past values. Okay, and quickly finishing up with some analytical stuff. So as I said, the model is simple enough to derive some analytical properties. And it replicates intuitive relationships between debt output, default probability, and borrowing cost. So the default probability increases when the debt increases and decreases when output increases, right? So that's quite intuitive. More interestingly, the relationship is highly nonlinear. It's actually a sigmoid shape. And we basically show here the graphs for Argentina and Greece. So in the first column, we have as an x-axis output shocks, and in the second axis, we have debt shocks, and in orange, we have the default probability, and in blue, the borrowing cost. An interesting thing to note here is that Greece in 2008 was on this flat area of the curve, right? But then the shocks tip it, if the shocks would be much bigger to dip it into the risk zone where the probability increases. But the steepness of the curve is actually much higher than for Argentina. So Argentina is already considered by investors as risky. So smaller shocks tip it towards the increasing probability regions, but the increase of the curve itself is slower. And I was actually happy with that, because if you think that reflects the idea that safe countries are safe until they're not, and then the investors panic. So that's Greece. And in here, we actually parameterize the sigmoids, and we show that for Argentina and Greece, the output shocks have a bigger impact on the default probability than the debt shocks of the same magnitude. And that's a property that occurs over 10,000 reasonable parameterizations that we checked. So that's a pretty general thing in the model. And we also have the model replicates intuitive relationships between policy variables and the target quantities, the growth and the borrowing cost. So we here have that the increase in investment increases growth reasonably, and the increase in investment also increases borrowing cost. And an increase in taxes reduces borrowing cost. So none of it is surprising, but it's nice that the model replicates the intuitive relationships. What's interesting is that a tax increase can lower or increase growth depending on a few factors. And they are, so it depends whether the government reinvests the additional revenues and what is the scale of this reinvestment. So we calculate a threshold for beta, after which the increase in taxes, if the government reinvests a sufficiently high fraction of it, actually leads to more growth. So to finish, the model is based on intuitive relationships between economic variables. It offers good agreement in sample, realistic dynamics, and high predictive power conditional on output. It reproduces 2001 default of Argentina and 2012 debt restructuring of Greece. with realistic conditional dynamics for debt spreads and credit rating in those examples. It generates realistic sovereign credit ratings based on a transparent methodology. I think the transparency here is like a big plus because we don't see it in the private providers. And it offers a tool for DSA and policy analysis, and characterizes the conditions for an increase in taxes to boost growth, and more details of it in the paper, and that's the bibliography. And thank you so much for having me and for listening.
Thank you. May I hand over to Thomas, and I'll share the screen.
Thank you, Klaus. Also, thanks to Karolina for presenting this interesting paper. I mean, we all know that credit rating agencies are supposed, or at least we have the doubt that they adjust their ratings too late, and your pictures seem to pick that and picked it up and confirm it. So that's a very interesting result, and I think the paper is a very well mixture between public finance issues and financial market issues. That's what I very much like with it. To the question whether this model can make the construction of credit ratings more transparent, I'm not so optimistic as you are. The reason is that if you look at the model is a small open economy model, so that excludes all the range of large economies like the United States, which are also heading towards a debt crisis at the moment. We'll see how that works out. And it also is restricted, at least as I have seen it, to a country implementing a currency peg. And that means you don't have monetary policy available to finance the state through seigniorage or an inflation tax or something like this. Rather, you have to rely on domestic bond buyers and international bond buyers. And I think that would change the dynamics of your model, particularly because you assume the inflation rate to be constant. And the experience that we have from highly indebted countries is that usually the inflation rate goes up, which shoots through the roof. So applicability, I would say, let's restrict it to small open economies with foreign currency denominated debt, and having a more or less credible exchange rate peg, at least a peg that guarantees that domestic monetary policy does not finance the public debt. Another thing that I don't like very much with the model is that investors have very sticky expectations. They expect the government spending ratio to GDP to be constant, or at least from the last period you take it over. They expect the credit ratings to be constant, and they do so regardless of whether they are domestic buyers of bonds or foreign buyers of bonds. And I expect that foreign buyers of bonds are a bit more, let's say, quicker than the domestic audience. Why? Because international investors in emerging markets, for example, are usually professionals. It's not the case that private households in Germany or UK buy Argentinian bonds. And therefore, they are probably more informed than private investors. And I'm pretty sure that they are more flexible in adjusting their portfolios than privates are. And that means the model does not have a feature like a run on the currency, which happened in Argentina when they had to leave the peg to the US dollar. You saw that with the jump in the debt ratio. Such a run is not within the model. You don't have it just. And I think runs like this, especially in public debt, are quite usual. Another point that I want to put on the table is the objective function of the government. You have shown it to us. It's defined in deviations from potential output growth, deviations from a target debt level, and deviations from a target deficit level, which corresponds quite good to the European case. In Greece, you have these target values from the Growth and Stability Pact, and you also have maybe something like a wish to dampen the business cycle on the side of the government. But especially in your two cases that you have shown to us, Argentina and Greece, my impression is that the government wanted to redistribute money towards their own electorate. And they used fiscal spending to do so, or tax cuts to do so, whatever it is. And the question that I have is, if you include something like this into your objective function, how do you think would that work out? What is a nice feature of the model on the other side is that if you reduce capital H, which is the horizon over which the government optimizes, if you reduce this, the government behaves more irresponsible. Right? And the longer H becomes, the more forward-looking the government is, and the more likely it forecasts correctly a possible default and implements austerity measures right in time rather than too late. That's a nice feature of the model, and that should be certainly something that you should keep in the model. A final point, you have shown to us that the reduction in public investment is more detrimental to the growth target of the government. So if you decrease public investment, it dampens growth more than if you increase taxes in the same size, let's say. I think this result is mainly due to the way you set up the model, because public investment directly affects Y through the demand equation, whereas an increase in taxes does not affect the private consumption level. And therefore, you have no effect on output, and that mirrors into your heat tables as a deep blue if you increase taxes. So that's my guess, but you would have to prove this. Okay, so far from my point, and floor is yours again.
Cool. Great. Do I need to move, or is here fine? Okay, so fine. Okay. Many good points, and actually, I'm glad for some of it I do comment in the paper, but didn't have time in the presentation.
That's the wrong.
So starting from the initial issues, yes, the lack of FX is a problem. And when I was designing the model, I mostly had emerging economies in mind, which borrow mostly in foreign currency. Well, I'm mostly interested in the foreign bondholders and foreign debt in general. And we don't include monetary policy, but those emerging countries mostly borrow in foreign currency denominated debt. They mostly have external debt. And the monetary policy, well, they cannot stabilize because it's tied to the peg, it's tied to the currency. They cannot dilute the currency to repay the foreign dominated debt. So that's why we don't have monetary policy. because it's not relevant for those countries I had in mind. We don't have an FX, but the inflation rates that we use is not the inflation of the local currency. It's the inflation on the currency in which the foreign debt is denominated. So for Argentina, that's US inflation. And the FX becomes relevant when the inflation adjusts slower than the FX itself, which is the case in many countries, but we also have quarterly frequency. So we should include this difference between FX and the inflation, the domestic inflation. And I think it's true that the model would benefit from modeling FX endogenously. It's just such a hard problem to model FX that I felt more confident at this point to take, for example, an external model of FX and just add it as an additional time series of the shock to the GDP. But yeah, I should have stated at the beginning that we're mostly interested in external debt of countries that borrow from foreign financial markets. It's true that investors have sticky expectations. It's a one period forecast, and I can actually run the model with in a way that the investors are not, their expectations are not sticky. And when it comes to the spending, it doesn't have that much impact. The credit ratings would have much impact if the investor themselves anticipated changes in the ratings. But it's a good comment. And I agree, because we focus on foreign markets and foreign buyers. They are more professional than the domestic and more quicker to react. It doesn't have a random currency. Again, that's a point about the FX that I've already made. Yeah, I didn't think about including the redistribution of money to the population in the objective function. I will think about that. Currently the setup is such that it's asymmetric, right? So it penalizes only the excessive debt and excessive deficit, and that to low growth, but it doesn't penalize high growth, right? So that was it only penalizes negative deviations from the targets. And yes, there is this feature of the longer the horizon, the more willing, effectively, the government implements fiscal austerity earlier. And this is why in the presentation I showed the Argentina with the reduced horizon, because with the horizon we used for Greece, which was the 2 years, which is based on the mean time till the next elections in a 4-year cycle, Argentina actually implements fiscal measures in 1996, which we know, or 1995, I think, which we know didn't happen in reality. And because of those fiscal austerity measures then, they actually are upgraded in the model to investment grade later on, and that stabilizes their situation later on. So when their budget deteriorates in 2000s, it's still, the spreads increase, but nowhere near to where they actually increase in real life. And we show that in the model as a consequence of the changes in horizon and how willing the country is to implement fiscal measures yearly. I agree that the reduction in public investment is more detrimental to growth because we underestimate the impact of the tax increase on the output. It doesn't affect private consumption, as you said, and it's a fault of the model. I spent a very long time trying to decide how to model the output and which components of the GDP to model and the interactions between them. It's hell, as every micro person knows. So I state in the model that we underestimate the impact of taxes in the paper that we underestimate the impact of taxes on the output because we don't include the impact of taxes on the consumption, but we do include the impact of taxes on the private investment because investors invest a fraction, the domestic sector invest a fraction of its after-tax income. And that's the impact of taxes on growth. But I agree, it's underestimated. Still, the result aligns with other empirical studies that look at the fact that in the long term, actually, because the governments tend to choose investment cuts over tax rates increases, and the other papers that I quote in the paper also agree that the long-term impact of the investment cuts are more detrimental to growth. But I agree, this should be more clearly stated that this is partly a build-up of the model that influences the results.
Simon?
I just have a quick follow-up comment on that. I think that it's horrible to model the taxes and the public investment. It's like, in addition to the comment of Thomas, one thing is like, whether you increase taxes and it's really bad for your economy, or whether you decrease public investment, it really starts where you start from. So if you're at the tax to GDP ratio of 5%, there's plenty of room to increase. If you're at 40%, yeah. And similar story, that there's certain public investment which is pretty much always good, but at a certain point you have to build all the roads, all the railways, blah, blah, blah. And then do additional investment might be just too much. So I think that the level where you start from should be important. I don't think it's easy to model. So it's like but I think that that's another issue here.
In what country would you have achieved all of your investment goals publicly?
None, but it's like I think if you have a public investment at 0.5% of GDP, there's probably more room for productive public investment if you already have like 10%.
Yeah.
Yeah, and it's true that actually, so in the data, advanced economies invest much less of their GDP than emerging economies because there is so little private investment. So they are more dependent on that investment in growth. And actually, the cuts in investments are even more detrimental to Argentina. And also taxes are much higher in advanced economies. The only way in which model accounts for that is in the parameter estimation for the private investment equation, which is very, very limited. But this is where the differences between the countries and the dependence would show. Also, in the very last part of my presentation, in the analytical part, I talked about how if you can increase taxes to increase growth, under the condition that you invest this increase and you invest enough of this increase. And this threshold on the value of beta that we estimate in the paper, it's actually placed on how dependent the economy is on the private investment, because your increase in taxes will cut the private investment. But if you invest even more as the government, then it leads to growth.
So it's a kind of, you model a crowding out indirectly.
Yes, but it's not, it's indirect, but it's not direct, right? And that's why also with this policy analysis, it's not only that we underestimate the impact of taxes because we don't include the impact of taxes on consumption, we also don't engage directly in this discussion about crowding in or crowding out.
Yeah, it's like it's an indirect crowding out because you reduce the funds to invest.
No, not in the model.
No, it's like.
So when the taxes are higher, it does reduce the funds of the private sector to invest in the economy.
So if you use taxes to.
The private investment is an AR1, part of the AR1 process.
Yes. So I don't have this equation in the presentation, but the investment is not A. So there is the AR1 for the consumption and the net exports, and the private investment is modeled in a separate equation. I didn't put in the presentation. So the way it works is that there is a fraction. The private investment is a fraction of the output minus the tax rates. It's a fraction of output minus the tax revenues. So the tax revenues are decreasing the denominator, and it's not an AR1 process, but it's close to it. And there are some additional multiplier from the growth. But through that channel, it reduces private investment in the economy. So that's a indirect crowding out.
Any more questions? Any further questions? So when I was listening to it, it occurred to me, I don't know if that can be operationalized at all, but I'm still saying it. When you showed the downward steps in terms of the rating for Greece, and which happened fairly slowly, and the drop when you stick to the fundamentals. So I was wondering why that was. Okay, one possible explanation you've already mentioned, which is data revision, so people weren't aware of what was actually happening. And I was wondering whether it could be the market sentiment, because back in the day, people implicitly thought that a Euro country wouldn't be able to default. There would be the Euro bloc and somehow covering for all that. And that increasingly turned out not to be the case. So and it took a while until the market actually picked up on that, hold on, this stuff is not risk-free anymore, as we thought, or had never been risk-free at the time they realized it.
So in our model, the sudden decrease in ratings, like quite sharp decrease in ratings, is mostly because the budget deteriorated so much. Like the deficit went to minus 15% of GDP. And we start deteriorating in the model when it's around 10, I think. And I do think it's hugely due to data revisions that S&P didn't deteriorate, their rating didn't deteriorate at the time, because the discrepancy between what they were reporting at the time and their projections and what was actually happening in the data I used is huge. But I agree, there is a lot of this market sentiment that it's a safe country, right? That Europe would support it and it will not default. But what we also see is that this initial downgrades in S&P, they were slow. And then when it started fully going down, it did go down. And that's partly because there is other empirical research showing that after a downgrade, there is usually a jump in spreads that goes beyond the change in fundamentals. So the downgrades the later downgrades especially tend to increase the panic. And this is what also happened later when the S&P started downgrading, the spread started jumping, and that further reduces the confidence.
And I take it doesn't make a difference if you take S&P or any of the other.
So the tricky thing about the rating agencies is that they actually don't publish these frequencies of default per rating class. I found one article, like one old publication on the web page that had them. I managed to download it, and a few weeks later, they actually took down the page. So I just have it as an HTML on my computer, and I couldn't find it for other. I actually didn't look very carefully, so I can try to do it for Moody and Fitch, but from what I know, they don't publish the frequencies nor the thresholds they actually use for downgrading. And I don't think they actually think in terms of only the default probabilities, right? There is also a lot of expert judgment and some kind of qualitative assessment that we don't know what it is. So I basically took down default frequencies and the ones I had.
Thomas?
Yeah. I think this has also to do with the structure of publications by rating agencies, because they usually publish a negative outlook before they change the rating. So if they change the rating without giving a negative outlook signal, this already has some sort of burning characteristic.
Yeah.
And I think they want to avoid this signaling, very bad signaling, so to say. And for this reason, they are acting slowly and then maybe also accumulate big reductions in the rating. And another thing, what you may consider is if instead of using the ex post published growth rates for Greece, what happens if you use the forecasts made by the European Commission at the beginning of the year or something like this? Because I'm quite sure in this case, your rating adjustment will also be slower.
Yeah. So that's the data I have thanks to Klaus, and I keep on gathering myself to do that because I do think it's exactly as you said, and I would be actually super interested to see when the adjustment happens, because I've seen the data and there is such a great discrepancy between the ex post and the forecasts at the time. But also with the credit rating agencies is that they explicitly say on their web pages that they would try to evaluate the country as a whole rather than the current macroeconomic conditions. So they are trying to have like out of business cycle look the trend more than the current conditions. And I do exactly the opposite, right? Like I attach so much value to the current budget and the estimates of the parameters on the past and the forecast from the current budget.
I think minding the time. Thanks again, Karolina. Thanks again, Thomas. Thank you also to the audience. Have a good afternoon.